everybody. Thank you. Thanks for the introduction and for the invitation to come to your group. It's always good to get out of Madison. As mentioned about some of the things that are going down there. Protests always every noon hour still continuing. It's not on the news, but if you want to go to the Capitol, they still have a sing-along protesting the governor. And the governor's expected to introduce his next state budget on February 20th, and so stay tuned as to what's going to be in there. He's said none of the fireworks of last time, but we'll see. So it's appreciate the opportunity to come here. I'm going to give a little bit about some of the politics because that's our organization, Community Bankers of Wisconsin. We are an advocacy organization. We represent about 200 banks, community banks in the state of Wisconsin, are active at the state capitol on your behalf, as well as in Washington, D.C., trying to hopefully stop, modify, amend some of the things that are coming down the chute towards you before they get to the rule and regulation stage. But we do a lot of educational training as well for our members. And I did hand out a brochure. We, about a year or so ago, we put together a marketing campaign trying to promote the differences between community banking in a very, I think, convoluted financial services industry. And so if anybody would like more of these brochures, we pass these out free of charge to our members, actually, and made them as lobby displays or customer statement stuffers. And then we have a host of TV, or not TV, but newspaper ads, lobby displays. And so if any of that is of interest to you, we're trying to promote the community banking industry in the state. So what is that? When you look at Wisconsin, and I did put in your packet of materials, it's called the Bankonomics Report. We put this together every quarter when the FDIC numbers come together, and we try to break it out by banks that are $1 billion and less in assets of the community banking sector. Because, as you know, when the FDIC releases their numbers, those are cumulative numbers for the state. And a few years ago, when we were having our bumps, particularly when M&I was still M&I, the numbers would come out, and when M&I was having their challenges, because of the size of their institution, they always skewed the numbers saying, well, the banks aren't doing well or loans are a problem. Well, so what we do is we put together this one-page report. It's on our website, and we send it out electronically to all the members. But communitybankers.org, you can get all of the past every quarter numbers. We got a lot of bankers who share this with their management teams and their board of directors. But it gives you more of a snapshot of what's going on within the community banking sector in the state. And as you can see from this particular profile, Wisconsin is a community banking state. The vast majority, about 96% of the banks, are $1 billion and less in assets that are headquartered here. So when we look at talking about the banking sector in Wisconsin, it is community banking focused. So how are we doing? These are just a few slides that I wanted to share, kind of looking at our trends. And again, the data is from institutions that are $1 billion and less. And as you can see, net interest income has held pretty steady despite the declining interest rates since 2001. So that's kind of a graph showing that. We've seen some improvements on our loan past dues. This is a percentage of the different sectors of the types of loans that the community bankers are making, commercial real estate, multifamily, 1 to 4. The home equity, there was a little bit of slight tick up on that on past dues. But you can see overall the trends have been good improvement on past due amounts. Looking at charge-offs, and this is we get some of this data from the FDIC out of the Chicago regional office, so they encompass several other states within the region. So they provided me with some data that shows how is Wisconsin comparing to our peer banks in other states, and pretty similar trends going back, again, from 2006 to third quarter of 12. But again, the trends are positive, at least when we look at the percentage of charge-offs to total loans in the last couple of years. And then when you break that down, again, this is Wisconsin data only, looking at the percentage charge-offs by sector of the loans, again, we're looking at some good trends going that way. When we look at loan balances, however, and again, that's kind of itemized on your Bankonomics report, we were seeing loan balances actually declining in most loan categories for community bankers. And as I travel the state, I hear this from a lot of the different regions. Loan demand still is really soft right now. The businesses are being really cautious about taking on additional debt right now. And so most banks in Wisconsin are looking for loan demand, and we see this in some of the balances. However, when we look at our capital ratios, the strength of our industry is on the uptick. So I think we've kind of gotten over our hiccups on the loans. We are increasing our capital ratios. The community banks that are left are really strong in improving that, and frankly are ready to make some loans. And we've told that to lawmakers and the media as well. This shows the ROA over the last couple years, looking at again the banks under $1 billion going in the right direction, as well as the ROE, again showing good trends for the industry. So that's kind of the quick update on how the state of the industry is doing. Again, I would say that I think the DFI Secretary Peter Bilstein made a comment in the media the other day when asked how the state of the banking industry is doing. I think he said the capital levels are the strongest they've been in 10 years. So that's good. We still have a couple banks in Wisconsin that are having some challenges. And we're trying to work through those, but overall, as an industry, I think we're seeing some good trends. So, from Madison, can't come out and speak outside of the Madison without talking a little bit about politics. So, how are we doing? And I was saying I had dinner with a couple of the folks last night, and see, I'm a little bit jaded since I worked downtown for a lot of times. That the protest is kind of like when you're downtown Madison, it's like, what's the protest today at noon? It's just like it's something that just kind of spontaneously pops up. We go out at noon hour, and it's kind of the same group of people. They kind of congregate, protest, whatever the thing is of the day. It tends to be where the newspaper or the reporters show up. They kind of mass. They put their signs up, and as soon as the reporters leave, you don't see this on the news. As soon as the reporters leave, they all kind of disperse, and they go and they show up again at noon hour the next day. So that's a little bit of what's happening in Madison. So I put this down since last fall was what I call status quo elections. We spent on federal elections somewhere in the estimated of $6 billion. About $310 billion was spent on state elections. How many of you were sick of the TV ads and radio ads? I sat there with my mute on the thing, but Wisconsin is a very good turnout. We are engaged in politics. We turn out and vote, and about 70% of the voters turned out in Wisconsin this last election. So what happened? So we have the same president. We have the same U.S. Senate control, the Democrats, same U.S. House control, Republicans. We all know what's happening in Washington with some of the gridlock. And then on the state side, the Assembly is still in full control of Republicans. And the one house in Wisconsin that has been continuing to kind of go back and forth is the state Senate. 3 majority switches in the last 2 years. And so in the recall elections this last year, the Democrats got control. Republicans in November got back in control. And so what happens in the Capitol is it's called musical offices. There is a pecking order that if you are in the majority in the state Capitol, you have the choice of what offices you want. So I think the staff people have moved boxes now 3 times, and it's I think at least now they're in control for the Republicans in control again. And with Scott Walker being our governor and Republican, basically under state rules they can do whatever they want because it's not like the filibuster at the federal level. And so I said stay tuned for February 20th. That's when the next state budget will be introduced. That's when a lot of the policy provisions and things that are going to be coming out will be discussed, debated, yelled at, all of the above. It was mentioned the mining bill right now is hot and center in Madison. Certainly that was something that was worked on last session, didn't get passed. It is probably priority number 1 and 2 for the Republicans to get something through this session. You're trying to, the Democrats feeling like they're being left out of the discussion. Why am I talking about this with banking? We have bankers in those parts of the state and with the industries that support mining that are really trying to see if get something done to get our economy going in the mining. I think something will happen eventually. I think February 5th or 6th is when the committees are scheduled to vote on at least the first provision of the mining bill, and so stay tuned on that. And you probably have heard from the governor's office that there is within the state budget some discussion about a state income tax cut with somewhere in that range of $300 to $350 million, with what they're saying, for the first time in several years now, they put money in a rainy day fund, and there's the revenues coming into the state are stronger than projected, and so there is some discussion at the Capitol about a state income tax cut. One of the things, getting to the banking side specifically, that we as an organization are working on a piece of legislation relates to the public deposits in Wisconsin. So for those of you who, the bankers that are working with like your local units of government, your villages and cities and school districts, those who are classified and defined under state law as a public depositor, there is under state statute a fund that's called the Public Deposit Guarantee Account. Currently has $48 million in it. And banks can go to those public depositors and say, above the FDIC limit of $250,000, there's an additional $400,000 in coverage under this public deposit guarantee account. And it statutorily is growing at 5% a year. So it has been kind of there. It's kind of under the radar screen. I did a survey of all the banks in the state to say how many of you work with your local public depositors in addressing that coverage, because as a banker, those local units of government are going to say, well, if you can't, above the FDIC coverage level of $250,000, we need additional collateral. So a lot of banks, pledge securities and other means to secure those local deposits, which are very important for the community banking sector. And so what we are looking at, we were talking with lawmakers and actually have a bill getting drafted right now to increase that coverage level from the $400,000 level to $750,000. And so you couple that with the $250,000 in FDIC premium or FDIC coverage, then you can go to your local public depositors and offer $1 million in coverage, which then lessens your reliance on pledging of securities and other collateral to secure those local deposits. Now, we fought really hard in Washington up until the December 31st for the extension of the TAG program, the Transaction Account Guarantee Program on the FDIC coverage, which provided that unlimited deposit coverage. The Congress failed to act on that extension before December 31st. So we kind of kicked in gear. This is kind of at least something that we can do to offer as an alternative to the TAG program. The TAG program, as you know, is put in place to provide some stability to the banking sector during that downturn, but Congress failed to act on the extension. So kind of stay tuned on this. We will be communicating to the banking industry to try to talk to your local state representatives and state senators to support this legislation as it moves into the bill introduction stage. But we feel very strongly about putting this in place. And when you look at this fund, again, a lot of bankers, some don't even realize this. This has been on the books in Wisconsin law since 1931. And so this fund has been around growing. It was something that was put in place, the Division of Banking, back in the 30s, 40s, and 50s, actually assessed institutions for their public deposits that they held on account at the bank. And so that fund was put in place. There hasn't been any assessments to the banks for quite a few years, and actually in 1955 they did some abolishing of that. In 1985, there was actually a legislative council study committee that made some changes to that. At that time in 1985, they put into statute this 5% growth rate. So the banks have kind of silently been having this fund grow, and it's not like there's a fund sitting in a bank account somewhere. What it is it's an obligation of the state of Wisconsin to stand behind public deposits in the event of a bank failure. So if a bank fails, the FDIC coverage obviously kicks in first. This would be covering public deposits above and beyond the FDIC level. And it's not even guaranteed that some of the recent banks that failed here the last couple of years, there hasn't been any losses to this fund. So what we're going to the lawmakers saying is, this provides some additional coverages for our banks. It's going to save the state of Wisconsin some money, because what we would do in exchange for the higher coverage level to $750,000, we are going to reset that to market rates. It's the only fair thing to do. Otherwise, over the next 10 years, that fund will grow at $30 million. And at some point, the way Madison works is you start to get such a large fund, like the transportation fund, they start tapping into it. And so we feel like this is the time right now in this legislative session to do something on it. So again, that's kind of one of our priorities at the state level, and we'll keep you apprised of it. On the federal level, and frankly, when you look at Wisconsin has very good banking laws, and so there's not a lot of wholesale changes we need to be doing at the state level to upgrade our banking laws. I say to bankers, your franchise value as banks is most impacted by what's happening in Washington, D.C., and not only in Congress but in the regulatory agencies. And so, as I said, Dodd-Frank is the law of the land. A lot of bankers were talking about we need to repeal. Last November's election solidified and put in place Dodd-Frank. It will be the law of the land. There will not be a repeal of that. And frankly, there were some things within Dodd-Frank that we pushed really hard as we knew the process was, Congress was going to do something. You can't come out of the financial meltdown that we did as a country and not address it at Congress. And as I think the President's Rahm Emanuel, former chief, he said you can't let a crisis go to waste. Well, they didn't, and they put in place a lot of changes. One of the things that we were very adamant about in that debate on Dodd-Frank was to try to differentiate community banks from the other larger too-big-to-fail institutions. And so Congress, when you talk to them and talk to even the state lawmakers, you said, well, yeah, you can't treat all the banking industry as one entity. You have to treat the community banks who have done a good job in working with your customers and your communities differently. And so one of the provisions that we enacted within Dodd-Frank was actually changing the FDIC assessments, going from deposits to assets. That saved 99% of the community banks a lot of money on their FDIC assessments. That would not have been done without a proactive lobbying force in Washington to make that change, and made it permanently. So just look at what you paid in FDIC premiums before Dodd-Frank and then what you paid in FDIC premiums after Dodd-Frank. It was pretty significant. And there were several provisions within there and that started to put tiered regulation in place, meaning that the 10 billion and less thresholds were started putting into law. Those are the first time in our history where community banks actually started to have some type of differentiation. We are working in Washington right now in trying to continue that process of saying there needs to be a different level of regulation for community banks versus the large too-big-to-fail institutions. And so that will continue to be our priority. This next session, who knows? GSE reform has been talked about. It's probably something that should have been discussed within Dodd-Frank, but it's such a big entity to put your arms around is what are we going to do with these GSEs? They're very important for the community banks as having a secondary market for the mortgages. But, and you've got some members of Congress who want to privatize the whole mortgage market, do away with Fannie and Freddie, and Federal Home Loan Bank I put in there as well because they've been lumped into some of those discussions. But we are, again, that's something we're not sure if Congress is going to take up this session or not, but it is on the forefront of at least some people's minds. I mentioned the tag program not extended. We try to provide enough advance notice to the bankers. I think a lot of those, we haven't heard a lot of horror stories of bankers who have lost large deposit accounts because of the expiration of the tag program. I did have one banker call me, and this kind of goes back to the issue on the public deposit guarantee account, who lost a large municipal account, and the city treasurer basically said, and this was in southern Wisconsin, who basically said it was a consortium of community banks that got together. It was a multi-million-dollar account, and the city treasurer said, well, we've decided to put our money in Wells Fargo because they're too big to fail. And he actually said that to the community bankers. So this whole thing about too big to fail and the mindset of some of the city treasurers and others, that is out there, and it's real. And so they lost the account because of that. And so I got that call, and it was very frustrating. So Basel III, that's something that was delayed. We are continuing to say that there should be an exemption for community banks under the Basel III Accord. That was something put in place on these capital standards for internationally active banks. That was the purpose of the Basel rules. So as I was at my conference last September talking about this, was when it was heating up, I said, how many of you banks are internationally active? Raise your hand. Nobody's hands goes up. So we are hopeful that because of the delay that the community banking industry was very loud and vocal in our advocacy. A lot of bankers sent in letters that ultimately when this does come out, something will come out that the protections and exemptions for the community banking industry are put in place there. I know you've got one of the other speakers who's going to be on from the web here is going to go into really detail on this, but I think from a federal side we can't dismiss. I want to just touch base a little bit on this Consumer Financial Protection Bureau. That's probably where the most activity is coming out of Dodd-Frank right now, and the things on qualified mortgages, on mortgage servicing rules, on compensation related to mortgages. And I think what we're seeing coming out of there right now, and again, I'm not going to go into detail because I think our other speaker is going to go into more of the specifics on the rule, but what I can say is the things that were coming out right now, there's a recognition from the Consumer Financial Protection Bureau that the community banking industry was not the cause of the problems within the mortgage market. And I think they are trying to balance the rules that are being put out there in recognition of that, to not stifle and not grind to a halt the whole mortgage industry. And so there are some legal protections that have been put in place for smaller community banks who, frankly, when you look at the performance of the mortgage industry, mortgage loans that are done by community banks are very high performing. I was on a national conference call with the OCC. I don't know how many national banks we have in here. And at that time they were talking about the Basel III Accord and some of the riskiness of having balloon loans. And there was bankers from all over the country on the call, and they were originating from D.C., and we had a banker from Minnesota who, during the course of the conference call, said, what is your data to support that balloon mortgage loans made by community banks have had high rates of default and have been risky? And there was this eerie silence from the regulator on the well, we don't have any data to support that. And this Minnesota banker who went on for the next several minutes to berate this, and I've been doing this for 20 years. The bankers are starting to get a little more vocal. That's good. We tend to be very conservative. But he said, we've been making these we know our customers. We know our communities. We've been doing these balloon mortgage loans for 25, 30 years. We've never had any defaults on it. And it works for our customers and works for our banks. You need to take that into consideration as you're putting these new rules in place. And there was kind of this silence. And they kind of went back and forth, and it kept going, what's your data to support that? They didn't have any data. Finally, the OCC representative said, well, we have to move on to the next caller. The next caller was from Kansas. I support the Minnesota banker, and I'm going to second that. And it was just, and again, I think it's time we work with our national trade group is ICBA, the Independent Community Bankers of America, and Cam Fine is their executive. And as Cam, if you've ever heard him either on in person or on a web or something, when he came to Washington, and he's a Missouri banker, had ran the Bankers Bank there, said the community bankers have to become more militantly active in Washington, D.C. to get our message out, and he's kind of carried that, and it's good to see the bankers doing that. I mentioned the mortgage servicing, again, exempting 5,000 or fewer mortgages, so if you're under that threshold, which is basically the community bank, vast majority of the community banks are under that, they recognize that your servicing, for those who you retain servicing on mortgages, are doing a good job on that recognition. Before I move on, though, and our other speaker might say this, but this just came out last Friday. There was a federal appeals court ruled that President Obama acted improperly in recess appointing members of the National Labor Relations Board, and including there might be some discussion about Richard Cordray, who is the director of the Consumer Financial Protection Bureau, was recess appointed, was not confirmed by the Senate, and now there is discussion in Washington to say, was the director of the Consumer Financial Protection Bureau put in place illegally? And this federal appeals court was citing that the President Obama was appointing these individuals illegally. It will be appealed to the U.S. Supreme Court likely. But I think there is starting to be discussion now in Washington because the Democrats don't want to change the structure of the Consumer Financial Protection Bureau. It's got basically a single director. And the Republicans, and we as an industry, have been advocating for a commission to have more of a 5-member panel that oversees the Bureau rather than one single individual. Maybe this court decision now is going to put in place some discussions with Republicans and Democrats saying we would agree to an appointment and confirmation of the director of CFPB in exchange for some structural changes to in a commission format. So, and we got some attorneys who are in Washington who are saying if the director of the CFPB was put in place illegally by the president, then would all of these rules that they're proposing now be illegal and have to be repealed and start over? So a lot of attorneys on both sides are discussing this in Washington, but this has just happened within last Friday's court ruling. So I guess stay tuned on the CFPB. I wanted to mention, and I talked about a little bit in my comments about differentiating community banks from the larger too-big-to-fail institutions. And so this last year, the FDIC, looking at the structural changes of the community bank industry, they did a study, which I encourage you to go to the FDIC.org and get a copy of this if you're interested in seeing what they talked about. But 95% of the U.S. banking organizations are community banks. But look at that. They only hold 14% of that banking assets, but make 46% of the small loans. And then it also said that 1 out of every 5 U.S. counties have no other physical banking office except those operated by community banks. So the FDIC is looking at how do we keep this industry competitive, viable, and strong going forward. I think there's a recognition from their side that something has to be done. These are some of the findings. Nothing earth-shattering, but we're relationship lenders. We're impacted by the increased regulations. We incur lower credit losses than non-community banks, and we're well capitalized. Bottom line is community banks are vital for our nation's economy, not only Wisconsin, but our nation. And so this study is looking at how do we put policies, regulations in place going forward that keep this industry viable. One of the things that's being discussed again in Washington, and this is coming out of a Federal Reserve governor out of Dallas, Richard Fisher, has advocated for, there's been discussion on the too big to fail and whether we should be breaking up the largest institutions who now, you've got 12 banks who are controlling almost 70% of the banking assets. 12 banks in this country now control 70% of the banking assets. And is that good? And the whole issue of just breaking them up is probably very difficult politically, but one of the things that's being discussed that is getting some issue is, should the banking practices of these large too-big-to-fail institutions be structured such that the commercial banking operations, kind of the traditional banking model, is covered under the FDIC safety net? All of the other activities of hedging and trading and securities activities would fall outside of the umbrella of the FDIC. So that is getting some traction. And again, this is being advocated by a Federal Reserve governor, and some people in Washington are actually looking at that. So that might be something, rather than breaking them up, is at least differentiating their commercial banking activities from the other activities of the institution. So with that, I'm going to stop, and I appreciate all your time, and I guess we'll be back for panel discussion later. So thank you.